Hello students, welcome to the lecture on Bank Reconciliation Statement. After this lecture, you will be able to learn the following objectives. Now let us start with the concept of Bank Reconciliation Statement. An organization maintains records of their bank and cash transactions in the cash book. The cash book shows the balance of the bank account as well as the cash account at the end of the accounting period. All the deposits and withdrawals are recorded in the bank column of the cash book of an organization. A bank statement is received periodically from the banker, and the transactions recorded in the cash book are verified by matching them with the bank statement.
Bank reconciliation. Completing a rec is crucial. Click on your company name and get into the reconciliation screen. So, why is it so important? Preparation of a bank reconciliation helps in the identification of errors in the accounting records. So basically ensures you haven't accidentally created a sales receipt for £1 million when it should have actually been £10, which was paid into your bank account. Cash is king. Bank reconciliations provide the necessary control mechanism to help protect the valuable resource through uncovering irregularities such as unauthorized bank withdrawals. Monthly preparation of bank reconciliation assists in the regular monitoring of your cash flow of a business, so it gives you a good idea of how your business is doing in cash terms. Now you know why it's so important, choose how often you want to do it. Weekly, monthly. When you reach the reconcile screen, select the account you want to reconcile. Record your statement ending date. This is the actual ending date of your actual bank statement you received or downloaded, and record the ending balance too. You can also add in your service charge for the account that your bank charges, and don't forget to enter those few pennies of interest that you gain. Now tick away. Only tick it if you match the transactions on both your QuickBooks and your actual bank statement. On the left hand side of the screen are all your expenses, and on the right hand side are all your deposits and income. So now you've completed your recs. Congratulations. Now look at the report of the reconciliation. You can give this report to your accountant, print it off, file it away with your bank statements, or if you are the accountant, have a look at it and revisit it whenever you like. Go to reports on the left hand side navigation. Now I use a search box as it's the quickest way. Just type in reconciliation and you will see it appear. Then just click on it, click on the reconciliation you want to see. All your previous recs will appear here too. And remember, they're all clickable.
Meaning of Bank Reconciliation Statement. When money is deposited into a bank by a customer, the bank updates the account of the customer by recording the entry in the debit side of the cash book. Similarly, when money is withdrawn from the bank, it is recorded in the credit side of the cash book. The bank also maintains an account of the customer in its books of account. In the books of account, deposits made by the customer are recorded on the credit side of the customer's account and withdrawals on the debit side. A copy of it is also given to the customer for his or her knowledge in the form of a bank statement or a statement of account. A bank reconciliation statement can be defined as a statement prepared at periodical intervals indicating the items that cause disagreement between the balances as per the bank columns of the cash book and the bank statement on any given date. This statement is important because of the following reasons. Brings out any error that may have been committed in either the cash book or the bank statement. Avoids any delay in the clearance of checks, which can be highlighted by the reconciliation. Helps management to check the accuracy of entries recorded in the cash book and keeps track of checks which may have been sent to the bank for collection.
Hello friends, welcome to our new accounting lesson. In this lesson we will discuss about the Bank Reconciliation Statement. It is an important document for all the organizations. Let's see, what is this, how it is prepared. Bank Reconciliation Statement. This statement is prepared normally at the end of each month. The purpose of this statement is to reconcile the balance as per cash book and the same as per bank passbook. Now let's discuss in detail. Transactions conducted between a bank and a firm are recorded by both bank and the firm. Firm maintains a separate bank column in the cash book to record all the banking transactions. And bank also opens a separate account for each firm in its books of accounts and gives a copy of this account to the firm for information, which is called bank passbook or bank statement. And we expect balance of both the books should be same. It is possible only when all the banking transactions are recorded both in the cash book and the bank passbook. Let's take an example.
Hello friends, here we have cash book, bank passbook and some banking transactions, and today I will show you how the balance of both the books will come same if all the banking transactions are recorded in both the books regularly. Now let's see the recording of these transactions in both the books. Our first transaction is opened a current account into a bank with $5,000, and the entry for this transaction will be bank debit and cash credit with $5,000. And as in the entry bank account is debited, so in the cash book on the debit side we will first write amount in the bank column $5,000 as bank account is debited. So that's why on the debit side of the cash book in bank column first we will write the amount $5,000, and in column for particular we will write the name of the credit account, and that is cash. This transaction will also be recorded on the credit side of cash book in the cash column, but here we are ignoring this. Now let's see how bank will record this transaction in the passbook. Bank will write this amount in the column for deposit $5,000, and in column for particular bank will write cash as the bank is getting the cash, and immediately the balance of passbook will become 5,000. So this is the recording of the first transaction in both the books. Now let's see the recording of the second transaction. Our second transaction is paid salary by check $2,000, and the check number is 105230, and the entry for this transaction is salary account debit, bank account credit with $2,000. And as bank is credited in the entry, so on the credit side of the cash book in the bank column first we will put the amount $2,000 as bank account is credited. So on the credit side in bank column we will write the amount 2,000, and in column for particular we will write the name of the opposite account, and here the opposite account is salary account. Now let's see how bank will record this transaction in the passbook. Bank will put this amount in the withdrawal column, and in column for particular bank will write cash paid against check number 105230. After this immediately the balance of passbook will change. Now the balance of passbook is 3,000, as total of deposit column is 5,000 and total of withdrawal column is 2,000. So 5,000 minus 2,000, and the balance is 3,000, and this is the credit balance because total of deposit column is more than the total of withdrawal column. Now finally both the transactions are recorded in both the books, cash book and bank passbook. Now the result of this recording is that both the books are showing same balance. Here cash book showing balance 3,000 and passbook is also showing balance 3,000. And the reason behind this is that both the transactions are recorded in both the books regularly.
Need for bank reconciliation statement. When an organization opens a current account in a bank, the bank provides the account holder with a bank statement, a checkbook, and a pay-in slip book. Whenever the organization withdraws money from the bank, it uses the check, whereas whenever it deposits money or check into the bank, that is, uses the pay-in slip. The bank statement mentions the amount withdrawn, deposited, and the balance amount. This is kept safely by the organization. The bank reconciliation statement is prepared periodically to ascertain that all the transactions related to the bank are recorded properly in the bank column of the cash book and in the passbook, bank passbook or bank statement. This statement provided by the bank is called a bank statement. The bank statement is provided regularly at short intervals after completing all the transactions up to the date of dispatch so that the concerned person can view his or her own account transaction as it appears in the ledger of the bank and report for correction if any discrepancies are there. Cause of difference between cash book and passbook balances. The list of causes of difference in the balances by the cash book and the bank statement on any particular date. Following are the causes of difference in the balances as shown by the cash book and the bank statement on any particular date. Checks deposited into the bank but not yet collected and credited. When checks are deposited into the bank, the account holders immediately debit his or her bank account with the related amount in his or her books of account. However, in the books of bank, the concern's account is not credited until they are actually collected by the bank. It is quite usual that some of the checks deposited by the concern may remain uncollected at the time the bank statement is sent for comparison. Checks issued but not yet present for payment. Similarly, the entry for the issue of check is made in the books of the concern immediately and the bank account is credited. However, in the books of bank, entry for payment can be made only when check is presented for payment. At the time of comparison, it is quite possible to find out some cases where checks were issued and recorded in the cash book but not presented for payment and remained unrecorded in the bank books and therefore causing a difference. Bank charges. Banks render various services to its clients and for that it levies charges. Entry for such charges is made by the bank, but the corresponding entry for the charges does not appear in the cash book of the concern because it is not known to the client until he or she receives a statement which causes a difference. Amount collected or credited by bank on standing instructions. Often, a concern issues standing instructions to the bank to collect dividend and interest on investments on its behalf. When the bank collects such amount, it immediately credits the concern's account with it. The necessary intimation and advice is sent to the concerned party after this is done. Amount paid or debited by the bank on standing instructions. The concern may also issue standing instructions to the bank for making some payments on its behalf and debit the concern's account with it. For example, life insurance premium, rent, and payment of installments. Interest credited by bank. Banks normally do not allow any interest on current accounts. However, if it is allowed, the concern's account is credited by bank, which would enhance the organization's balance with bank. On the other hand, the organization would record it on the debit side of the bank account in the cash book only when the bank statement is received. Interest debited by bank on overdraft. If the organization withdraws more money from the bank than the available deposits with it, then it is called an overdraft. Overdraft facility is permitted to the party by the bank only when it fulfills certain conditions. The bank charges interest on overdrawn balances. Direct payment by customers into the bank account. Sometimes customers may deposit money directly into the organization's account in the bank. The bank would immediately record the entry on the credit side of the organization's account and therefore in the bank statement and enhance the balance. However, the organization would debit the bank account in the cash book only when it gets the intimation or the bank statement. Dishonor of check or bills. When checks are deposited in the bank for collection, the organization debits the bank account in the cash book. It increases the balance immediately. However, the bank would credit the proceeds of checks only when they are collected. If due to some reasons few checks are dishonored, the bank would not credit the organization's account. The organization would credit the bank account only on receiving the intimation or the bank statement from the bank. Errors. Difference in two balances may also be due to some errors in the recording of transactions by either the organization or the bank. For example, the check deposited in the bank for collection may not be recorded at all, or check may be forgotten to be sent to the bank though necessary entry has been recorded in the cash book. Procedure of preparing a bank reconciliation statement. Generally, at the end of every month, the entries in the cash book are compared with the entries in the passbook. For determining the exact cause of difference between the two, these books are examined and then a reconciliation statement is prepared. In this statement, all the causes of differences are down. Suitable correcting entries are passed in the books if necessary. For preparing a bank reconciliation statement on a given date, the following procedure is adopted. Take balances either as per the cash book or the passbook as a starting point. Compare the items appearing in the bank column of the cash book with the items appearing in the bank column of passbook. Items in the passbook are marked with the entries in the cash book. After that, a list is made of items which are found unmarked either in the cash book or in the passbook. The unmarked entries in the cash book or passbook indicate the reason for disagreement. Marked items in the cash book represent either the checks that are deposited in the bank but not collected and credited in the passbook, or the checks issued but not yet presented for payment. The unmarked items in the passbook are related to the credits given for interest allowed by bank, deposits for dividends, interest on investments received by bank, debits with respect to bank charges, and payments made by bank. Adjust the balance that is taken as a starting point. If the balance as per the cash book has been taken as a starting point, then the cash book balance must be adjusted in accordance with the entries passed in the passbook and vice versa.
George here is about to perform a bank reconciliation. The procedure for doing this is as follows. Step 1. Firstly, we have to tick off the bank statement to the cash book. This involves identifying each item recorded on the bank statement that also appears in the cash book. This is done by checking the amounts and details on the statement and in the cash book. Where amounts and details correspond, we tick off the items on both the statement and the cash book. So the first item shown on the bank statement that is also in the cash book is check number 011291, which is a payment we've made to Spooky Timers. So we need to tick off both of the entries as being matched. We simply carry on going through all of the receipts and payments and tick off all of the ones that are shown in both the bank statement and the cash book. Once we've ticked off all the items that we can, we move on to the next step. So, for step 2, we now need to update the cash book for all the items that appear on the bank statement but are not shown in the cash book. This typically includes items such as standing orders, direct debits, bank charges and interest. We don't record them in the cash book until the bank statement arrives, as we won't be certain about the details, dates and amounts until we actually see them on the statement. So we need to find all the items on the bank statement that we didn't tick off. For each one, we need to write it up in the cash book. The first item relates to a direct debit payment to SW Telephone Services for £220.15, so this is the first entry to record in the cash book. Once all the unticked items on the statement have been written up in the cash book should be complete. We then need to balance off the cash book. To do this, we need to identify which side of the cash book is the greatest in terms of monetary value, the receipt side in this instance, indicating that we have money in the bank. We total up the receipt side, and the figure we arrive at is immediately recorded as a total in both the receipts and payment side. The items on the payment side of the cash book do not currently add up to the total we have just recorded, so to rectify this we need to calculate a balancing figure. So, add up the amounts on the payment side and deduct the figure from the total. This figure will become your balance carried down figure, which in this instance is £706.18. We transfer this figure to the receipt side of the cash book, below the total, and this brought down figure represents the amount we actually have in the bank, i.e. £706.18. Step 3 is to produce a reconciliation to ensure that what we think is in our bank account agrees with what the bank thinks we have in our bank account. The only differences should be 1. Outstanding checks, i.e. money we've paid out but hasn't cleared yet, meaning that these payments do not appear on the bank statement yet. And 2. Unrecorded lodgements, i.e. money that we've paid into our bank account, e.g. from sales, but hasn't cleared yet, meaning that these receipts do not appear on the bank statement yet. These are known as timing differences. We should always look out for errors, which are more likely to be in the cash book, and the bank statement is much more likely to be accurate.
Now in the end, let us summarize what we have learnt in this lecture. Summary.